I'm hoping to have two webinars live every month. So one is today. Hopefully in next 2 weeks, we can also do it. Um, what is going to be the format? I think we'll all discuss and figure out what the format is going to be like. At least we can do one market analysis. And if the team so desires, we can also do a stock analysis. And there is a lot going on in the market. Uh, Today is a great day because obviously the markets are red, and they've been red for the last little while, which is great because that gives an opportunity to investors like us to nitpick and start picking stocks of great quality companies. So without further ado, I'm just going to go through the market analysis. So here's a screenshot of what's been happening in the market. The candlesticks represent the S&P 500. The red line represents the NASDAQ, or the maroon line represents the NASDAQ. Okay, so the green line represents the S&P 500, or which is also represented by these candlestick patterns. Since the beginning of the year, the S&P 500 has gone down by 1.95%. But in the middle of February, the market was pretty high. It was the S&P 500 had reached 4%, and the Russell 2000 or Dow Jones index had also gone close to 7%. So that means there was a momentum that was going up, but suddenly something happened. And I'm going to discuss in great detail of what had happened. So NASDAQ went down to minus 2.52% as of today. Russell 2000 minus 6.45, and Dow Jones Industrial has actually Dow Jones Industrial is the only one that is up, and it's currently sitting at 1.17% as of today. So the question is, what is causing this dip? So let's analyze that. The first cause of the market dip is the trade war that President Donald Trump has started with Canada, Mexico, and China. So as you know, on March 4th, which was just a couple days ago, President Trump imposed 25% tariff from imports from Canada, Mexico, and they already had 10% tariff on China. So they said we're going to increase that by another 10%. So bringing it to 20%. So in retaliation, China said, great, we're going to add 10 to 15% tariff on US imports starting March 10th. And Canada also said that, well, we are going to impose 25% tariff on $155 billion worth of US goods. And Mexico said that they also have similar plans to add tariffs to things that are coming from the US to Mexico. So what this is doing is the increased tariffs will make imported goods more expensive. So the goods that are coming into US are going to become more expensive. Now, there are a couple of things that happen in the market. Before March 4th, which is before the tariffs were announced, what the businesses did was because they knew that the tariffs were coming, they rushed to increase the imports of the goods that they were going to get. So they rushed to increase those imports so that they could avoid short-term tariffs that would have come on those products. But what that did was the short-term inflation spiked because of that sudden demand for the goods, which had surged. The stock market before March 4th dipped because of the uncertainty around the future economic costs. But after the tariffs were imposed, which is after March 4th, so yesterday and today, what's happening is that we know that the cost of goods from Canada and Mexico and China have now gone up. So what this is going to do is it's going to make things expensive, which will cause the consumers to reduce their spending. And when businesses face higher costs and lower demand because people will reduce their spending, what that's going to do is it's going to slow down the growth. What that does is it impacts the bond yields. But before I go into bond yields, I want to just quickly explain the behavior of bond yields and what it tells us about the market. And in the past, I've spoken a lot about these, but it gives a very telling story of what's happening. We know that inflation increases the prices of goods and services, right? So if whatever a burger was supposed to cost last year, it's going to just become more and more expensive this year. That's basically inflation. But when there is a fear of inflation, what that means is people think that things will become more and more expensive. And when that happens, investors want higher returns from their bonds, right? But since they had purchased bonds earlier with lower yields, what they do is they sell the bonds. So this is very important to remember. So when people think that inflation is going to occur or inflation is going to increase, investors demand higher returns from bonds. So because they already own bonds, what they do is they sell them. And when they sell, the bond volume increases. And when the bond volume increases, the price of the bond goes down. And why does the price of bond goes down? Because the supply of the bond increases. Now, because the price is inversely related to bond yield, the yield goes up. So because they had sold bonds at earlier, which had lower yields, now because the yield goes up, they buy the bonds right back. And when they buy the bonds back, they're actually now end up procuring bonds at a higher yield, which is what happens when there is a fear of inflation. And also when there's a fear of inflation, Feds also come in and they try to interject. And this is exactly what they did in 2022. And they do that raising the bank's interest rates to slow down that inflation. So again, this is the story I'm telling you when there is a fear of inflation. And higher bank interest rates also make new bonds more attractive because they are issued at higher coupon rates. So again, investors sell older bonds with lower yields and purchase bonds with higher yields. Is that what's happening this time? The answer is no. This time, the story is slightly different. This time, the bond yields have actually gone down. So let me show you.
Amit, one quick
Yeah, go ahead.
question. What is the definition of yield of any? Is it only for bonds or is it for a stock or for any
So I'll tell you,
investment?
when I use the term yield,
Yeah.
I actually mean the rate of return. So what happens is when you buy a bond is not like what you do in stock market. You buy stocks that go up and then you can sell them. There is slight
Okay.
up and down in the bond price as well. But bonds are purchased in the secondary market. They're not easily or they're not typically available in like, investors, brokers, or
Okay.
uh, you know, TD Ameritrade. You got to go to a secondary market to purchase them. This could be just a straight bank. You go and buy them from a bank. But when you buy a bond, the bond comes with a yield. That means it'll say, okay, you'll get 4.5% over the next 3 years every year.
Okay.
Now, if
So
you want
like
to sell them,
sorry. So 5 years is a lock-in period for that money you're in.
5 years could be lock-in period or a 3 year could be lock-in period. Now, if you want to sell them, you got to find a seller. Now, sometimes a bank may buy it or maybe somebody else will buy it. And then you'll discuss, okay, what price am I going to sell it at? That's why it's called that this is in a secondary market. There are ETFs that you can acquire that invest in bonds, and you can trade those ETFs exactly like how you buy or sell a stock in the stock market. And the rate of its growth is based on the bond yield at that time.
That's good. Thank you so much.
Is that happening right now, which is what I just discussed? The answer is no. What's actually happening this times is that the bond yields have gone down. So if you notice, this is the bond yield, it's gone down. And this is the bond yield of a 10-year US Treasury bill. What that means is that market is not right now scared about inflation. Instead, what the market is scared about is a market slowdown that could lead to a recession. And how do we know that? Remember I said that the bond price is inversely proportional to bond yield? So when the bond yield goes down, means that the bond prices have gone up. So if you notice, that's exactly what's happening. In this second chart, I have the figure of S&P 500 in the candlestick chart pattern. And the green line represents the bond price and the red represents the yield. What people are doing right now is they think that because market is going to slow down and there's a fear of recession, they're taking their money out of the stock market and putting it in the bonds. And again, when the supply of something goes down, what happens? Its price goes up. So the bond price is increasing. And because the bond price, so if I say bond price, inversely related to the bond yield or the percentage, that means as the bond price goes up, which is what's happening right here, bond price is going up, the yield is actually going down. And why is this happening? Because the retail investors, in their mind, there is going to be a slowdown and there is a risk of recession. And is there anything else that tells us that there is a risk of recession? Well, yes, there is. And again, this risk is really just a fear. There's no guarantee. And also because nobody has a crystal ball, right? So why do retail investors put money in the bonds when there is a fear of recession? Because because bonds are safer, right? Bonds are backed by somebody. There could be corporate bonds, there could be treasury bonds. So if you've gone through the first course that I have, where I go in great detail, which is freely available on our website, Informed and Invested, I have explained that bonds could be from the US government, and they're called the US Treasury bills. They're backed by the US government. So people take money from the stock market and they're like, okay, I want it in a safer place. So they put it in bonds. But what happens is, as us who are retail investors, who are educated people, we can see these patterns and say, oh, when this happens, it happens because of the following reason. So in this case, the reason is there is a fear of market slowdown that could lead to a recession. Again, there's no guarantee of any of that, but it could lead to that. And again, as I mentioned, is there any other indication that supports that there is a fear of recession? Well, there is, and let's walk through that. So this is Atlanta Fed. What they do is they regularly monitor what is happening in the economy, because typically rest of the banks, what they do is they see when a full quarter is finished, then they go back and check all the figures like, okay, what were the imports, exports, how did the employment go up? And then they determine whether the previous quarter was a growing quarter and what was a GDP growth, or it was a reducing quarter and what was a GDP reduction. Atlanta Fed is one of the only ones that actually checks this in real time. If you notice on the left side here, this shows the dates when Atlanta Fed was measuring different kinds of figures. And then this column shows you the GDP. Then you have the different measures that are economic measures, also including imports, exports, the consumer price index, et cetera, et cetera. So you notice the GDP in January, February, everything was looking good, like 3.1, 2.3, 2.9. So GDP growth was at that time being measured fairly well, and it was looking positive. But what happened just last week and earlier this week, right here, March 3, March 4, March 5, March 6. So today's March 6. So you notice right now, the Atlanta Fed is starting to project a negative GDP growth. And that's very interesting because that shows something has happened in the market, which these banks are also picking up. And this is very recent, right? This just happened over the next few days. As a matter of fact, even today, March 6th, you're seeing a negative 2.4 GDP growth that they're estimating in real time. And why is this happening? Let me bring your attention to the net exports right here, this column. You notice starting 3rd of March, the net exports became negative. This is the reason why the GDP figures, at least over the last couple of days, started to show negative. So what was happening was, remember when I started the presentation, I said that before March 4th, when President Trump said that we are going to impose tariffs on Canada and Mexico and China, the importers in the US immediately increased the number or the quantity of imports that they were going to have. Instead of waiting, they actually started importing them earlier so that they could avoid those tariffs and get those products at cheaper rates. So when the imports go up compared to exports, that means the net import becomes negative. So it is because of this figure where the imports suddenly increased very heavily that it started to negatively influence the overall GDP. Now, moving forward, if the slowdown continues, which means because the products are going to become expensive in the US, and if that slowdown continues, the GDP may continue to remain negative. And if that goes on for 2 consecutive quarters, then technically we enter a period of recession. And when recession occurs, then the feds come in and they start to do a whole lot of things. Now I'm going to bring your attention back to my presentation, at which point I was discussing.
Amit, one quick thing, right?
Yeah, please go ahead.
The GDP numbers here is for one quarter.
Yes, good question. This is actually showing the first quarter GDP updated. So for instance, if we look at the 3rd of March right here, it's showing that as of the first quarter, January till the end of March, this is the GDP coming up as of now.
So starting 28th it went into a negative territory.
Yes, starting 28th of February, they said the GDP for the first quarter is now negative.
That's ending March,
January till March.
31st, 2020.
Yes, that's right. That's why, because this is live. So even though the first quarter hasn't ended, they're already starting to forecast that it's heading towards a negative.
Okay. And that's this is for entire US, right? Doesn't like only for Georgia, Atlanta.
Just US. Okay. So now let me bring your attention back.
So you think all this retaliation, like Canada also imposing 25%, it will be bad for the economy?
Say that again, please.
Like the retaliatory tariff that Canada will also impose. And then I think US said that only for auto, there would be a exemption for 1 month, right? Or something. from Canada.
Yeah, Canada is going to impose the tariffs.
Yeah,
How long
the
they will
reta
be imposed for, we don't know that. I think ultimately these are all tactics for both the governments to come to a certain understanding. Um,
right. It's like a
but
Trump negotiation tactic, I think.
100%, it's a negotiation tactic. So Canada, Mexico, these countries are also doing their own negotiation tactics. So ultimately, we will all come to a certain equilibrium. What that equilibrium is yet to be seen. So we're all looking forward to that. And we'll also discuss it, I'm sure, as, as the time goes along. But here's the thing, that ultimately the rates will be cut, right? So if I go back to my previous slide, you'll notice that there is a website called CME Group. This is called the Fed Watch tool. They regularly watch and estimate what is going to be what is the probability of the interest rates going down. Okay, this is the Fed Watch tool. So Fed Watch tool tells us at any given time what is a probability that the FOMC, which is a Federal Open Market Committee, which is run by the Feds, is going to reduce the interest rates. So what you notice here in front of you are the probabilities of the interest rates being cut in different months or different. So because these guys have their meetings very regularly. So for example, this here shows you a certain time when this is going to be done. So this meeting is going to be held on the 18th of June. And then it tells you underneath what are the different interest rates. Currently, as you know, the interest rate in the federal interest rate is between 4.25 and 4.5%. So in June, it's saying that the probability of the interest rate being cut by 0.25%, 51.2%. And the probability of the interest rate remaining at 4.25 to 4.5% is 20%. So there is a higher probability of a rate cut occurring in June this year. If we fast forward to September, so 17th of September at that meeting, there is a probability of the interest rate getting further cut to 3.75 to 4%. And what is that probability looking like? It's at 37.9%. Similarly, as we fast forward to December, there is a probability of another rate cut. So that's looking at 3.5 to 3.75%, so another 25 basis point. And the probability of that happening is 32.2%. So again, these are probabilities. We don't know whether they're really going to happen. But at the very least, what you can understand is that the Feds are already looking to cut interest rates. Now, if the market continues to slow down, there is a chance at quarter two also, or if the quarter two also GDP also becomes negative, then US is going to be technically in a recession. And when that happens, the Feds, at least in theory, are supposed to come in and reduce the interest rates. Why? Because by reducing the interest rates, they actually stimulate spending and investment. And how do they do that? So let's say when the interest rate goes down, then businesses who were holding off on taking loans to spend money will come in and take that loan and invest in their business. It could be either they'll purchase new real estate or they'll start new programs or hire more people, right? Those kinds of things happen. Other reasons when the Feds can come in and reduce the interest rates could be in the case of unemployment. So if layoffs spread, then the Feds are likely to start acting. Other is if the inflation cools down more. So if inflation naturally declines due to weak consumer demand, then the Feds are going to cut interest rates. But if the inflation remains high, which means inflation doesn't go down, then the Feds are not going to cut interest rates that aggressively. So we all have to sit and watch and see how this plays out. And lastly, if the market crashes because of recession fears, then the Feds can also come in to work with the interest rates to stabilize the economy. So for example, in 2019, which is not that far ago, the Feds cut interest rates after the trade war uncertainty. And that also, which was at that time slowing down the growth of the markets. Remember, Trump has done a trade war with the US already, and I'll talk about when that was done, but it was in 2019 timeframe. This year, we are expecting at least two rate cuts. So there might be even three. But that's where we have to, again, it's going to depend on how the market is doing and what are the signs of it. Does anybody have a question on this?
Yeah, Amit, one question.
Yeah,
So Fed is targeting like inflation, like you say, they want around 2%, right? So if
want
they
the inflation to be around 2%.
correct, yeah, inflation, not the rate, yeah. So
Yeah.
if that is the case, then they will not reduce the interest rates, right? If they're okay with the inflation numbers,
Take the inflation numbers, but inflation numbers are increasing actually. I don't have a
2.7,
slide.
I think.
2.7, yeah. So they want the inflation to go down. Now, if the inflation comes to 2%, because it had come down, again, I don't have that chart, but it had come down, but it started to go back up. They want the inflation to go down. Inflation isn't at like the crazy it was at in 2022, right? So it's not there at this time, but
But
it's the slowdown it's an economic slowdown that's going to help cause them to reduce their rates. But inflation, if the inflation continues to increase, they may increase rates or not
yeah,
change them.
that's right, yeah, that's what I meant.
Because think about why that happens. If the inflation basically means things are becoming expensive. And when do things become expensive? When there's a lot of demand for things.
Demand is more, yeah.
So to cool the demand, they say we have to make less money available in the market. And how do they do that? One of the tools they have in their kit is increase interest rates. But that's not happening this time. It's the other way around.
Yeah.
Any
Amit, one question. You said like the GDP still it goes into negative for the second quarter. The Fed will come into picture and again they will reduce the rates, right? And how it will ensure that by reducing the rate, it I mean how it will impact or how it will have an positive impact like once they cut the rate. I mean, just trying to understand the situation here. If the
I'm
recession,
gonna talk about exactly that in great detail in my next slide.
okay.
I have a nice slide ready for that.
Yeah, Amit,
Go ahead, guys.
so Ramesh here, yeah. So, do you see any chance of the interest rate going up? So the reason things, right? The retail slowdown, consumer slowdown, and then uh, yeah. So and then the
So,
inflation is going up.
so Ramesh, from what we understand is we just think logically. Why do Feds increase interest rate? They increase interest rates to reduce the supply of money in the market. And when they reduce the supply of money in the market, when they think there's too much money and too much being spent. And when there's too much money being spent, things become expensive. Why? Because the demand goes up. Right now, the demand isn't necessarily up. There's going to be a slowdown. So people are going to, because the price of things are going to go up because of tariffs, logically, retailers are going to spend less money in the market. And when retailers spend less money in the market, what that does is it slows down the market. Now, to increase the speed of the market, because the Fed's job is to work as like they press the brakes when things get too hot, and they press on the accelerator when things become too slow. So when things become too slow from a consumer spending point of view, the Feds are going to say, okay, let's lower the interest rates, make the money available so people start buying things. Real estate's going to have a have a great time. But let me talk about that in a bit. Any other questions on that?
Yeah, that's okay.
Yeah,
Okay.
Amit, one question. Sorry.
Yeah, go
Sorry.
ahead, go ahead, go ahead.
So tariff is something for a particular good or a product, right? Between countries or something.
Correct.
So how does tariff affect the supply and demand?
Okay. Tariff is another way of a country saying taxes. When you send me
Taxes.
something, I'm going to charge you an import duty or import tax. Okay. Like, you bring something, and you must be aware that, like, you buy something from another country, you bring it
Yeah.
in an airplane, and they see you, they're like, oh, you have to pay duty on that. That's basically what it is. So when a duty is charged, so let's say there's a product worth $100. And US has said we're going to charge 25% tariff. Now the cost to the importer, so if you are the one who's importing a full container of things from Canada, that $100 product has now just become $125. Now, what are you going to do? You're obviously going to pay the $125 to get that product. But now you need to make profit out of that. So you're going to sell those things at least 25% more expensive to the retailers, right? So now the retailers, which could be your uncle, your cousin, or whoever, who now goes in a shop to buy that product, is now going to pay 25% more. Now, why is President Trump doing it? President Trump is not a fool, right? He's a businessman. The reason he's doing it is to encourage Americans to buy things that are American. So if they bought, let's say, maple syrup from Canada, and the same maple syrup is available in the US for 25% cheaper, where's the retailer going to go? He's going to buy an American product. But what that's also going to do is it's going to encourage Americans to start manufacturing those products. Initially, there's going to be a hit in the US economy because things are going to become expensive. But ultimately, as US finds or retailers find alternatives, things are going to start going back to normal. Now, other thing is that these other countries on whom import duty has been imposed, the attractiveness of their products is going to go down in the US. So what do they have to do? They now have to find other buyers. So they'll, instead of Canada just concentrating heavily on the US, they'll now start looking elsewhere, which is good for the Canadian economy, only depending that if the Canadian sellers are able to find sufficient amount of buyers outside. Second is both US and Canada will come to an equilibrium of understanding some point in time where the US will say, okay, great, I wanted you to spend ABC, maybe reduce the deficit, blah, 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 whatever that is, they'll come to an understanding of some sort. And I think that the countries will move on from that point. When that'll happen, we don't know, but this has an impact on the stock market and it has an impact on our purchasing decisions. So our purpose by going through this is so that we are that much more educated so we can make informed and educated decisions accordingly. Now,
So, I mean, earliest we might know since December numbers were all, or Q4 numbers of last year are already good, right? So there's no recession that time. So you're saying like maybe 2 quarters, right? So earliest we might know probably is August or July or August, whether there's a recession.
yeah, I mean, so it's 2 quarters. So January, February, March is 1 quarter. April, May, June is 2nd quarter. So sometime at the end of June, if we find out that there was also a decline in the 2nd quarter, then you can say that the US has entered recession. And what is the requirement to enter a recession? It's
2 quarters.
simultaneous quarters of negative GDP growth. We are monitoring and seeing that it's looking like the 1st quarter is going to be negative. Will it actually happen? Is something that we have to wait and watch. Now, here, any other questions, guys? This is really good. I like this two-way conversation. So this is a slide because somebody here asked, I don't know who was the person who asked, but asked, what are the impacts of rate cuts? So here's a slide I have. So first of all, when the Feds reduce interest rates, the stock market tends to rise. Why does it rise? Because lower interest rates make borrowing cheaper. And when borrowing becomes cheaper, companies can take on loans. They invest in the companies. What that does is it increases corporate profits. And when corporate profits goes up, it encourages investments from outside, and that encourages the growth in the fair market value of that stock. So that's why the stock market goes up. Investors also shift from bonds and they start putting money back in the stock market. And at that time, the bond yields decline, which makes the equities more attractive. Next is that the consumers and the businesses increase their borrowing. So as the loans become cheaper, consumers and businesses obviously start to take on more loans. Businesses take loans and invest in their companies. People start to take loans and they purchase homes, they purchase cars, they start spending money through their credit cards. And companies also start to expand their operations because of lower financing costs. Right now, if you notice that Russell 2000 over the last little while has not been doing well, right? Russell 2000 represents small to medium-sized companies in the US. What do you think that might be? What might be causing a low growth to these kinds of companies? Because these are small to medium-sized companies, they often depend heavily on debt. So when the debt is very expensive, they're not going to go and buy. They're not going to take on loans. That's one of the contributing reasons to why Russell 2000 is not doing well. But on the negative side, when the interest rates go down, it reduces the demand of US dollar. And the reason is because as the treasury yields go down, fewer foreigners invest in US treasuries that are sold in US dollars. And when fewer people invest in US treasuries, which are sold in US dollars, it lowers the demand of US dollars. And when the demand of US dollar goes down, it weakens the US dollar. But then there is also, on the flip side, there is a benefit. And what is the benefit? The benefit is on the US goods, because the US goods become cheaper to international buyers, so it boosts US exports. American multinational companies, so when the US dollar goes down, the American multinational companies also benefit. Why? Because currencies of other countries become a little more valuable than the US dollar was previously. So when they sell in other countries and they convert that money back to US dollars, the US companies actually get more money. So this increases their earnings when they convert the money back to US dollars, and then it increases profitability, which helps American companies, and then ultimately it helps the stock market. So it's that circle why the stock market starts to do well as the interest rate goes down. Now, which industries typically benefit the most out of interest rate cuts? Biggest winner is real estate and REITs. So why is that? Because when the interest rate goes down, mortgage rate goes down. And when mortgage rates goes down, then people look to purchase houses or they will refinance, etc. And REITs, which are real estate investment trusts, they also benefit because they now get access to better financing or their interest rates go down, so their profitability goes up. Also, growth in technical stocks or the tech sector does well because lower rates boost their growths, so they do well. The industries that actually struggle are energy and commodities. And the reason is if the rates weaken US dollar, then because energy is being purchased from other countries, the price goes up. So the consumers end up paying that price. Now, I was also telling you the other reason why the stock market may not have done very well right now, or maybe going down, is because of seasonality. And what does seasonality mean? Seasonality means the common trends of the S&P 500 over the course of many years. So here's something that has been produced by Equity Clock that shows the performance of the S&P 500 over a 20-year range, ending on the 31st of December 2024. So it's very, very recent. So you notice that S&P 500 typically doesn't do overly well in January and February, and in February actually goes down until March and then it picks up. So this might be the reason. So far, it's played out exactly as per the seasonality chart. Whether this continues or not is going to be seen. I like to see this more as an entertainment, but again, to tell you that seasonality might also be playing a role in this. There's also a term in the stock market which is sell in May and go away, and that also is supported by the seasonality chart. Notice in May, the stock market typically plateaus and then goes sideways until late June, and then it starts to pick up thereafter. Again, these are not things that we should typically use when we are investing in the markets, but seasonality is something for you guys to keep in mind. Again, it starts to plateau again, and then there is typically what's called a Santa Claus rally towards the end of it. Moving forward, another reason why we think the markets might be performing poorly is because of the government fiscal policy changes that have been happening. So our buddy, Mr. Elon Musk. So Elon Musk is leading DOGE, D-O-G-E, Department of Government Efficiency in the United States. And what he's done is he sent layoff notices to a lot of people. And apparently, unemployment claims in the US, especially in the Washington area, have risen by 22,000 to 242,000 in the last 3 months. And what basically this does is it signals a potential economic downturn, even though the labor market otherwise is fairly healthy. But those figures that we have in the the GDP, etc., they're always like a couple months behind. But these figures that unemployment claims have increased, that's very recent and may be a sign for future impact on these inflation and the GDP figures that come out. There have also been news that in January 2025, about 100 tech companies, primarily in the US, have collectively laid off 30,000 people. And the reasons they're quoting are related to restructuring efforts, market optimization, and integration of AI. So anyhow, these could be other reasons why the markets are kind of in a wobbly situation right now. So what has actually happened in the market? So I have a chart in front of me. This is something you can get from FinViz. It's also available in various other places. But this is basically the 1-month performance of stocks inside the S&P 500. And if you look at this kind of a chart carefully, you'll notice that it is broken down by different sectors. So first you have the technology sector, then it talks about consumer cyclical, then semiconductors, financials, etc. And you'll notice that most of the companies in these sectors have not done overly well over the last month, which is not necessarily a bad thing. If you know how to calculate the fair market values of stocks, then these could be great times to start nibbling. Like last year, I was barely able to purchase anything because everything was going up. Now there are opportunities to buy, and since January, I have been in the market, plucking things and like to again start rebuilding and adding to my portfolio. So you notice, look at this. Microsoft has gone down by 2.93%. Amazon's gone down by 12%. Apple's up in 1 month by 3.46%. Google is down by 13.56%. Meta down by 5.84%, etc., etc. Berkshire Hathaway is up by 7.57%. And because of Dr. Gopi, who asked me a question about Berkshire Hathaway, which is a company owned by Warren Buffett, I have some slides towards the end of how they're performing as well. Okay.
So have you bottomed out?
Have I bought what?
No, have you bottomed in the stock market? Is it a good point for entry right now?
Well,
Or
let's think about that. Let's think about that. So again, whatever I'm about to say is not an advice. So when do we buy stocks? We buy stocks when they go below their fair market value. And if you know how to do technical analysis, then you typically pick them up at support levels or resistance levels, right? So let's say there's a support, you buy it at support. So based on each investor's risk tolerance, you would decide what is your portfolio mix, because you never want to have all your stocks in one basket. So you want to have the diversification, which could be sector diversification, industry diversification, stock diversification, geographic diversification, and you can even have different ETFs. So and also bonds. So based on those diversifications, if you find that a certain stock falls below your fair market value, and that you are not going to invest all your money in one shot, then this is a great time to start nibbling. I have been nibbling on a lot of stocks. I have added to a lot of these growth companies that have gone down. Again, I want to inform you that the wise way to invest is make sure you have a diversification, make sure you have calculated the fair market values of stocks, and you know how you pre-planned how much you want to invest towards one stock in a certain year. And at any time you go and buy the stock, don't put all your money at that one shot. So let's say if you have $100,000 and you had decided that in one specific stock during that year you'll spend $5,000. Well, don't put all $5,000 in one shot, because you don't know whether the market's going to go down further. Break it down in 4 pieces, right? Or 5 pieces or 6 pieces, and say every time I go buy, I'm not going to buy more than $800. So if the market goes down further, you have enough bullets left to purchase more, right? That's just a strategy you can follow. Does that answer your question, sir?
Yes, thank you.
Okay. Now, moving on, here's a chart I have that shows how many times the market has gone into conflicts. It's a chart I've shown many times. It's a chart I've copied from the first course that I have available. But why I brought this here is I want to bring your attention to right here, US-China trade war. So there was a trade war that happened between US-China in 2018, and President Trump was a president at that time, and the market did go down. At that time, I think it had touched close to, let me see, it had touched at that time 20%. Okay, so right now the market has only dipped by around 6%. So the current dip is nowhere close to what had happened at that time. Now, what's also interesting to note is in 2018, the market dipped by 20% and then went right back up. And why am I using the term 20% as a term of interest? Because 20% actually means a bear territory. At that time, the market was in bear mode for like a day, and then it went right back up. Again, giving people like us opportunities to invest and pick up stocks at great prices. And like last couple of years, the market has done really, really well. And those of you who've been investing in the stock market and know how to do it should have made a lot of money. All right, guys, here is something else I want to bring to your attention so people don't panic. This chart shows the average frequency of dips. So currently we have a dip, right? There's a dip on an uptrend. Why an uptrend? Because the moving averages are going up, so it's an uptrend. So there is a dip on an uptrend, and there are some calculated frequencies that have been done through, just an analysis of how the markets behave. So this chart shows me the average frequency, average length of that frequency when the market takes a dip. So first I have 5%, then 10%, then 15%, then 20%. So typically, how many times does the market hit a minus 5% dip? Well, that happens typically 3 times a year, and it lasts for 43 days. When did that last happen? Well, it just happened. So this could be one of those this year that this has taken place. So, you know, when somebody says the market only goes up and I don't have a chance to buy, no, not true. The market gives you ample opportunities to come buy, to come and purchase stocks at good prices, but it requires patience and it requires that stability. You don't just, the fear of missing out is something you have to get rid of. And this is what I'm hoping, right? Like these kinds of conversations we have with people and the community that we have, it's a great place when you are able to talk to other individuals. You don't feel left alone. So how many times the market take a dip of 10%? It happens typically 1 time a year, and that could last for about 3 months or 110 days. Last it happened was in October 2023. 15% or more, well, that happens once every 3 years, and that did happen. It happened in the next slide I'll show you. So that happened in 2023. There was a 27% decline because of inflation fears. And stock market dipping 20% or more, which represents bear market, that happens 1 time every 6 years. And when was the last time it happened? Well, it happened, so 20%. So right here, that also happened in 2023. So while it was supposed to happen once every 6 years, it's already happened. It happened more than that. So it also happened in 2020 because of COVID. So in COVID, the market dipped to around 35%, and 2023 it happened 27%. So we saw 2 bear markets already in the last, let's say 5 years. So if this is to happen once every 6 years, chances of that happening again statistically are not very high, but it can happen. But it's good. I just want to bring this to your attention that keep in mind that opportunities come and it's up to us as to how many we avail. So this chart that I was referring back and fro, is something where basically it shows the stock market since around 2016 and how it behaved and how much it had dipped. So I actually went this morning and figured out how much they had dipped. So US-China trade war that happened in 2018, 2019 timeframe, from here to here, the market dipped just 20% and then it picked right back up. During COVID, 35%. Go ahead, please. Somebody ask a question. Okay. Then 27% decline because of inflation. Then in 2024 or late 2023, earlier there was an 11% dip. Then a 9% dip happened in 2024. And right now we're sitting at about 6.8% dip. So, you know, if you look at the long-term moving averages, you'll notice that it's somewhere close to a moving average. So this is good. I think there's still more chances of a dip. So if I were to just say that, you know, where would the supports be? So support is anywhere where the market has had a ceiling or a dip at least 3 times. So if I were to draw them out, you know, roughly there is a support and a resistance here. There's another one here and another one somewhere close to here. So that's how you see. So if the market comes to this point, if you're interested in the, you know, let's say interested in investing in the index and you want to wait for what are the different levels. So one level could be here, another level could be when the market comes to here, then here. So if you slow down your purchases of these over the course of the time when the market takes a dip, if you're investing in ETFs, then this is how you could purchase. Or you could say, maybe I'll just do it on a very certain frequency. I mean, there's so many ways of investing that we have discussed in the past. All right, guys. Now, Dr. Gopi, who's one of our subscribers of our channel, last week when I said that I'm going to do this webinar, if anybody has any questions, he said, "Oh yeah, I want you to go through the investments of Warren Buffett." So Warren Buffett invests, his company is called Berkshire Hathaway. So I said, okay, I'll do a quick analysis on that. And then if anybody has any further questions, we can delve deeper into those questions in the future. So what I have right in front of me is the growth of Berkshire Hathaway compared to the S&P 500. So this is starting since 1965 and goes all the way till the end of last year, so 2024. So the first column here shows you the performance of the Berkshire Hathaway, or the stock portfolio that Warren Buffett and Charlie Munger manage, but Charlie Munger's passed away. So this was their return, and then the S&P 500 is on the right side. So you'll notice that if I bring you to the very end, you'll notice here that the overall growth of of Berkshire Hathaway's portfolio since 1965 till the end of last year has been 5.5 million% growth. Okay, 5.5 million% growth, which is insane. And the same growth of the S&P 500 during the same period has been 39,054%. So I encourage you guys to go to Berkshire Hathaway's website. I've written the source here. This information is available. It's in his letter. So there's a section there of letters. So look at the 2024 letter, and he puts these figures there. So they're all available. And remember, S&P 500 is a combination of 500 top companies, whereas Berkshire Hathaway selects their own companies. So they are careful in what they invest. They have their own mechanism of investing, and their performance has been very good. Other thing to note here is that the compounded annual growth rate of Berkshire Hathaway from 1965 to 2024 has been almost 20%, or exactly 19.9%, which is fantastic. My returns that I invest are also very similar to this. So I consider Berkshire Hathaway or Warren Buffett as a person from whom I've learned a great deal. So the knowledge that he has observed, gained, and learned has helped people like me, and I hope it can help people like you too. Now, moving on with Berkshire Hathaway analysis. So I thought that as I analyze the companies, let's see what kind of sectors does he put his money in. So in the next slide, I have found his portfolio, or Berkshire Hathaway's portfolio. Whether it's accurate or not, I actually don't know, but I got it from this company's website called Whale Wisdom. So hopefully it's accurate, but basically I took this and I put it in a pivot chart and a pivot table, and I analyzed this. So what I found was, based on those figures, his largest investment is in finance companies, followed by information technology, and then followed by consumer staples. So finance, as you know, these are banks. He's also into real estate, etc. But information technology being things like, your Googles, your like Apples of the world. And the consumer staples end up becoming like Amazons and these kinds of companies. So essentially, this is the biggest portion of his portfolio. I have not done an analysis as to how well each of these sectors has done, because he also invests in energy, and I personally don't like to invest in energy because it's so heavily influenced by geopolitics. And also, I like to invest in companies which have monopoly. But anyways, he has his philosophy. He's obviously done very well. You, as individual investors, can also develop your own methodology and philosophy based on what you feel comfortable with. Proceeding forward, I have this chart which I'll be happy to make available to you guys from in Excel. So I'll put it in our Telegram, so anybody who wants to download it can download it. So folks, this brings me to the end of today's webinar. Again, this was my effort to restart these conversations with you all. I really appreciate, I kept seeing a lot of people were joining, but I don't really know how many people have joined, but I really appreciate all of you coming. Help me understand, what did you think of this webinar today? Is there anything specific you want to discuss next time? My motivation essentially when I do these webinars is it gives me a chance to also practice my craft. So, and having a community is always a great thing. Oh, we have a lot of people. So guys, I open it up to you. Let me know any questions, anything specific you want to talk about next time. I was actually thinking next time I analyze a company, but I'll leave it to you all. What do you think?
Amit, first of all, thank you for such a great presentation. I mean, it gives like a little investor savvy like me who don't have time to go through the news every day to figure out. This gives me a glimpse of what's happening and catching me up to the speed. So the one small suggestion that I struggle myself as a novice investor is, I know you say you talk about investing in 4 different buckets or 6 different buckets, right?
I do. What did you say about buckets?
Oh, no. Yeah, you said when you're investing in a stock, just don't invest in 100%. Just go in buckets, like 4 tranches or 6 tranches, like 20% and all that, right?
Yeah, that's called dollar cost averaging. Yeah.
Correct. The DCA. So the problem that I always have is I don't know enough for the technical analysis to be done on a stock to see, okay, these might be the good buy areas. I'm not sure if there's any insights that you can give or pointers for us to do our own technical analysis. That might be a good topic for the next
Why don't we
one.
discuss that next time? Why don't we
Yeah.
talk technical analysis next time?
Yeah.
Okay.
Just
Technical analysis,
I know it all
I've done
differs from different measures that they do, right? Technically, some do the bands and all that, but I'm not
I was
going to
just
go
going to
into
get to
that.
that. There are so many ways of doing technical analysis, but ultimately, I think technical analysis really boils down to a few things, right? The overall trend of the market or the trend of the stock. What are supports and resistances where the stock typically has a pattern? How do you figure that pattern out? You can do that. I think that's good. Otherwise, like if you guys want to go into these kinds of studies, like I know a lot of them, but I don't even use them.
Yeah. No. That's what I'm trying to say. That we're not going to go into those studies. I mean, there are like 4 or 5 indicators, like the RSI. What does that mean? I mean, people look at those 4 major ones, right? 4 or 5 major
I'll tell you
ones.
what. I'll go through what I think technical analysis should be, but I would request the members of this community, if there are any specific studies like RSI or Bollinger Bands that you want me to go over, just put that in the Telegram chat. I will make sure that in 2 weeks when I come back with, I have some educated information to discuss. How's that?
Okay, sounds good.
Okay. Vinod, go ahead. My buddy Vinod.
Hey, hey, thanks, Amit, for the session. Pretty good information, as always.
And thank you for coming. I was counting. I was like, I hope Vinod.
Yeah.
Okay, go ahead.
A lot of times I see that like say if I just go to Amazon.com or something, right? They'll say that, okay, Warren Buffett bought this, he sold this. And a lot of times I think you'll see the list of stocks he holds. Like when we see something like that, like, is it like, should we follow that? Like, okay, he bought something, then we buy and then something
I
like
can't
that?
say that about you. I don't.
You don't? Okay.
Oh my goodness. I've never. Like I'm an educated person. I want to use my own brain. So again, this whole thing boils down to your comfort of investing. So for instance, there's certain areas I don't invest in, right?
Yeah.
And I have certain mechanisms, like I want to make sure that the revenue's got to look in a certain way. The behavior has to be in a certain way. If it is not, I don't put money. Now, if something really compels that, I'm like, oh my goodness, I really, really want it, then I have a discipline on that. My discipline is if I would, let's say I call a certain stock as a speculative stock, right? So like PLTR last year, Palantir, it was a speculative stock. And I said, I'm only going to have 1% allocation on it. So I did have 1% allocation on it, but that stock skyrocketed. So if it skyrockets, it skyrockets. But what if it doesn't skyrocket? So I'm not losing more than 1%. Just forget about it. So, which is because I have a method to my investment and I stick to it. Otherwise, if you have a method and you're like, oh, I'm going to change it for this person and that person, then after 10 of them, what do you have? You have like a mix of nothing.
And I also, somewhere I read, or I don't know, like say there is a S&P 500, right? Similarly, Warren Buffett also has something like that, a pool of stocks.
I mean, it's his Berkshire Hathaway portfolio. I don't know if they have given it a separate name. I have no idea that I'm unaware.
Oh, okay.
Okay, like the stock portfolio, like if you want to see his performance, it's brk.b. brk.b. That's the portfolio.
That's the portfolio. Okay. Yeah, I seen like dash A, dash B, something like that. Yeah.
So I look at the B. I mean, that's the one. I'm not overly educated on the other things that they run, just because there's so much in the market. So I just pay attention to my philosophy of investing, and I've done like last year my return was somewhere close to like 20%. Okay, but again, every person's mileage is going to vary. You all must create your own investment style based on your own risk tolerance, right? Some people also put money in bonds, right? The 60-40 split is very common. They'll put 40% in in bonds and 60% in stocks, or the other way around, based on how old you are. Some people may say, okay, we're also going to put some money in alternative investments. So again, it boils down on your risk tolerance.
Yeah.
Anybody else? Murali, I like your profile photo. Anyways, anybody else? Any other questions?
Yeah, hi, Amit. Thanks for the session.
No problem, Ramesh.
So is the recording is available? You know,
We'll make the recording. Yes. All right, guys. Well, thank you so much for your time. We were able to occupy a lunch hour. Murali, you want to say something?
No, I'm just going to say, yeah, appreciate you. Thank you. Yeah, so very insightful and informative as always. So yeah, just yeah, shout out to you for doing this. Yeah.
Thank you. Thank you. I really
Yeah,
appreciate
thank
your time. And next week, let's do something on technical analysis.
Thank you, sir.
Yeah,
Thank you. Yeah.
Okay.
Thank you.
Yeah, everybody. Thank you.
Yeah, thanks, Amit, for providing your insight on what is happening right now. I was very much interested in attending the session, so definitely we'll be communicating right now when the next we'll be having.
Yeah, let's just call it in 2 weeks.
Okay, perfect. Thank you.
Thank you.